We all know China's real estate market is collapsed. However, the big question is, will China's problems affect the US real estate market? A quick answer is no. But the real story behind it, you will want to stick around for that. Real estate is a big deal in China, making up a whopping 30% of their GDP. In contrast, in the United States, real estate is less influential, accounting for only about 15% of the economy, with the residential housing being just 3 to 5% of that. Even during the 2008 crisis, the US housing market only dropped about 18%.
2008 was a bad year. It was a bloody year on Wall Street.
But the Chinese real estate price has already fallen close to 30%, with no signs of slowing down. To uncover the deeper layer of this chaos, I urge you to hit the like button and subscribe. The story doesn't end here, and you do not want to miss what I'm about to tell you. There is a significant income gap between two countries. In the US, the average household earns over $67,000 a year, a far cry from China's average income of just over $4,200. Surprisingly though, the cost of living in China isn't much cheaper. To illustrate, let's consider it in the perspective of a general blue-collar worker in each country. In the US, buying a pound of beef costs about 30 minutes worth of one's daily wages. But in China, that same pound of beef will cost the same worker half a day's worth of earnings. In 2022, once mighty companies like Evergrande and Country Garden are in deep financial troubles. Country Garden lost nearly $1 billion, which ballooned to a staggering $6.7 billion by the first half of 2023. Meanwhile, Evergrande's stock price, once valued at $42 billion, plummeted to less than $1 billion. Shares that used to trade between $2 to $3 are now worth a mere $0.0006, marking an astonishing 99.98% loss in value. In the US, a real estate transaction involves the buyer and seller exchanging money and the property at the same time, often performed by a closing attorney. But in China, it's different. The buyer borrows the money and starts paying off the full mortgage amount before the house is even received, often even before the first brick is laid. However, instead of using these funds to construct a house, the developer often invests this money in more land or initiates other projects. It's not about starting new projects, it's about raising more money from more buyers by selling more promised future homes. This infinite loop of money making further inflated the bubble. Evergrande pre-sold 1.4 million homes, collected deposits, yet left those homes unfinished. Why is this a significant crisis? Chinese local governments rely heavily on income from land sales to real estate developers.
Local governments have been relying on real estate growth to meet their GDP targets.
This revenue boosts both the GDP and local incomes. However, this reliance triggered a massive debt crisis, with local government financing vehicles amassing a staggering $9.6 trillion in debt, over half of China's annual GDP. China's economic growth model centers around investments, focusing on building extensive infrastructures like roads, bridges, and factories. Take Country Garden for instance, a shining example of China's economic growth. Their sales went from $3.8 billion in 2010 to a whopping $57.3 billion in 2018, with an impressive 44.3% average growth rate over 8 years. To put that into perspective, one of the best performing stocks in the Nasdaq was Apple during the same time period, with an average rate of 21.4%, less than half of what Country Garden's growth rate. Leverage, in the best of times, can be a rather powerful tool. In the early 2000s, China was riding high on a wave of financial success, and companies like Evergrande went all in on leveraging. The result? Over-construction. With more houses than demand could ever satisfy, China found itself burdened with an excess of 65 million vacant homes, a number equivalent to the entire population of France or the United Kingdom, not to mention the diminishing birth rates and the growing exodus of its people. To put that into comparison, the United States currently faces a housing shortage of about 6 million homes, with millions trying to move into the US every year. Real estate investment is a way of life in China. Almost everyone invests. Buying a home and holding it for a few years almost guarantees a profit. In the United States, 66% of Americans are homeowners. In China, it's over 90%, soaring to 96% in rural areas. Over 20% of Chinese citizens own multiple homes, a figure much lower at 6% in America. In the 1990s, there was a housing boom fueled by China's urbanization wave. But things have changed. We are now facing not one but three distinct waves. The first is the shock of COVID-19 shutdowns, of course, which caused the current price drop in prices. Yet, the second wave comes from a surge in unemployment.
Coinciding with the graduation season, estimated 11.58 million people flooding the job market.
With a record high rate of 21%, 47% in youth alone. The third wave arises from the diminishing birth rates and an aging population, shaping a new reality. It's essential to note that the home prices have already dropped by 8.5% from January to July this year. Smaller cities felt this impact the most, by the way.
Of not getting the home that they paid for.
The problems China have now are deep-seated structural ones.
Furthermore, used home prices have been consistently declining since 2018, falling by a daunting 20 to 30%. This may have just been the beginning of this storm. As the challenges in the Chinese sector grow, there's a pressing question: could this affect the United States? In the US, the historical average for the cost of a home has been about 5 times the annual household income. But in China, it's a different story. To afford an average-sized house, a typical Chinese household would need to save their entire disposable income for over 30 years. This ratio is more than 6 times that of the US. In Shanghai, it can take over 80 years of your income to buy a house, or actually just the right to lease your house from the government for the next 70 years. Much longer compared to most places in the US, where it might take just half a year to 3 years. So it's clear that China faces a tougher challenge than Americans when it comes to housing affordability. It's essential to recognize that the US real estate market stands on a more mature and well-established foundation compared to its Chinese counterpart. The United States has a long history of real estate transactions, supported by a well-developed legal and regulatory system that protects both buyers and sellers. In contrast, the Chinese real estate market is relatively new and less developed, lacking the same level of transparency, and participants face higher risks. Adding another layer, the US real estate market isn't as heavily reliant on the Chinese market as some other sectors. While Chinese investment in American real estate is on the rise, it still represents a relatively small fraction of the overall market. In terms of economic diversity, the United States is more diversified, not relying as heavily on a single sector as China does on real estate. This diversity provides a resilience to the US economy when faced with impacts in one particular sector. As we wrap up this topic, it's crystal clear that the US residential real estate market remains, for the time being, a world apart from China's real estate troubles. But remember, the global economy operates like a butterfly effect. Small changes can lead to significant consequences.
New home sales was very strong, really kind of shattered estimates and the highest in a long period of time.
Even though the US market appears insulated, we must keep our eyes on the bigger picture. If you have any thoughts or different perspectives on this matter, whether you agree or disagree, please share them in the comments down below. Stay informed, stay smart, and subscribe.